If you ask your parents or grandparents for financial advice, you'll hear the same rules that worked reliably in the mid-20th century. Save 10%, put 20% down on a house, and stay out of debt. But for most people graduating today, executing that exact playbook feels like running on a treadmill. You do everything by the book, yet home ownership keeps slipping away, and your savings account barely covers a single emergency. This graph tracks the core problem over the last decade. Look at the flat line at the bottom representing average wage growth. Now compare it to the two lines shooting upward, the appreciation rate of real estate and the cost of college tuition. That widening gap changes the math of wealth building. Waiting to hit traditional savings targets while asset prices explode means you are chasing a target that accelerates faster than your income. Reaching financial independence today requires moving away from these comfortable conventions. You have to understand how to use leverage and capital more aggressively than previous generations did. Treating personal finance like a mid-century checklist is an unwinnable game. Success now depends on your ability to adapt to the new math of the current economy. One of the most stubborn rules taught in school is that you must save a 20% down payment to avoid private mortgage insurance, or PMI. In this matrix, you can see the flaw in that logic. The slow-filling bar is an average worker's cash savings. The target threshold is the rising cost of a home. In many markets, the home price increases faster than the worker can realistically save cash. When the model shifts to this alternative path, we see the power of leverage. By paying the PMI penalty now, you secure the asset at today's price. The equity you gain through appreciation over the next 5 years often dwarfs the total cost of those insurance premiums. This same principle applies directly to credit. Avoiding credit cards entirely to stay safe actually cripples your financial leverage by leaving you without a credit history. The operational requirement is simple. Treat the credit card like a debit card. By paying balances perfectly on time, you build the high credit score necessary to secure low-interest loans for future assets. Leveraging measured, strategic debt to acquire assets early is often a more viable path than hoarding cash while the market moves out of reach. There is a deeply ingrained assumption that a 4-year degree from a pristine institution is the only path to a stable career. However, taking on 6 figures of student debt before you even earn your first paycheck severely limits your ability to invest. Every dollar used to service that debt is a dollar that loses out on decades of potential compound growth. There are modern alternatives to the traditional debt trap, starting at community colleges, pursuing employer-sponsored tuition, or working part-time to reduce the principal loan amount. Higher education is a major capital investment. You have to strictly evaluate the cost of the degree against the actual return on investment it will provide for your specific career path. School curriculums often suggest saving 10% of your income. But if you're earning a typical salary, a 10% rate leaves very little principal to grow, meaning the interest alone will rarely replace your income before you're too old to enjoy it. To actually build a self-sustaining nest egg, the modern target for the average earner is closer to 25 or even 40%. This requires a radical reduction in lifestyle inflation. This visualization shows the exponential power of compounding interest. By fueling your accounts with aggressive early capital, you create a massive base that multiplies much faster than smaller, delayed investments ever could. To find that extra capital without the burnout of daily tracking, try tactical budgeting. Plan your fixed needs and wants in solid 6-month blocks, separating the money into different accounts so you don't have to make micro decisions every day. Before any of that money goes into the market, you must secure a 6-month emergency fund. This acts as your foundation, preventing you from having to sell your investments during a market downturn. Eliminating the need to track every penny frees up the mental bandwidth you need to focus on high-leverage, long-term capital allocation. Even the most disciplined investment plan can be wiped out by a single medical crisis. Without insurance, a hospital visit for a major injury can cost thousands, instantly draining your capital. Shielding your wealth requires sacrificing some current discretionary income for health and term life insurance premiums. It is a necessary trade-off to protect your long-term net worth. This pay stub shows another invisible leak: taxes. Because of the marginal tax rate, a $6,000 raise rarely means an extra $500 in your bank account every month. Calculating your exact post-tax net pay is mandatory. You need these numbers to accurately price your services or decide if a new job offer actually meets your financial needs. Protecting your wealth requires active management of taxes and insurance, rather than relying on automated HR defaults. Building wealth today requires a specific sequence of operations, where your first move is determined by your current financial baseline. This flowchart maps the strategy for an overwhelmed beginner. If you are starting with high debt and low cash, the system routes you to two mandatory nodes: the 6-month emergency fund and the tactical 6-month budget. The trade-off for the beginner is time. You must accept delayed gratification on big purchases until you have established this baseline safety. Once that foundation is locked, the flowchart pans down to the optimizer level. This stage focuses on macro leverage, hitting a high savings rate, using PMI strategically to enter the housing market, and optimizing for tax efficiency. The optimizer's trade-off is lifestyle. You are trading short-term luxury consumption for accelerated market entry and decades of compound growth. Regardless of where you are on the flowchart, you must choose your trade-offs consciously, rather than defaulting to the advice of the past. The math has changed. Choosing your trade-offs today provides the mathematical foundation necessary to secure financial independence later.